Euro and Yuan global ambition accelerate pressure on the US dollar. The US dollar is once again under mounting pressure, retreating against both the Euro and China's Yuan at the moment, when European and Chinese policymakers are openly championing the global expansion of their currencies. What appears on the surface to be a routine exchange rate adjustment may in fact signal a more structural recalibration of the international monetary order, one that Washington itself seems increasingly willing to tolerate. Over the past year, the dollar has declined roughly 6% against the Chinese renminbi, with the offshore yuan climbing to its strongest level in nearly 3 years. The euro's ascent has been even more striking, appreciating about 15% over the same period and hovering near 5-year highs above $1.20. The dollar's softening follows a year marked by aggressive and unconventional US trade diplomacy. Former President Donald Trump has described earlier dollar weakness as great, while Treasury Secretary Scott Bessent has carefully reframed the traditional strong dollar doctrine, suggesting that currency strength should be understood as a function of sound long-term policy rather than immediate exchange rate levels. This rhetorical nuance has not been lost on global markets. Investors are increasingly weighing the implications of a Washington that appears more comfortable with dollar depreciation, particularly if it facilitates trade rebalancing and capital reallocation. Notably, while the dollar has weakened against both the euro and yuan, the euro-yuan exchange rate has remained comparatively stable. Given the deep trade interdependence between Europe and China, this equilibrium carries strategic significance. The yuan accounts for the substantial share of the euro's trade-weighted basket, nearly rivaling the dollar's weighting. Conversely, the euro plays a similarly prominent role in China's currency basket. Any sustained dollar slide against one currency is likely to reverberate through the other. Despite these developments, the dollar remains unrivaled in global finance. Its share of international foreign exchange reserves, as reported to the IMF, has declined gradually but continues to dwarf that of its competitors. The greenback still underpins the majority of the global trade invoicing, debt issuance, and cross-border investment flows. Yet the symbolism of current moment is difficult to ignore. The euro is positioning itself as a more assertive reserve currency. China is accelerating efforts to embed the yuan in global trade network, and the United States appear less resistant to currency adjustment than its previous eras. Whether this dynamic culminates in a negotiated monetary realignment or simply reflects cyclical market forces remains uncertain. What is clear, however, is that currency market can shift rapidly when policy rhetoric, capital flows, and geopolitical strategy align.